This chapter, we're going to talk about the fundamentals of product costing. So we have our cost management systems basically are designed to help people make decisions, and they're also designed so that the benefit do not exceed the costs of maintaining these cost management systems. So they're going to help us make decisions, and then we'll accumulate reports to kind of report back on those things. So why is it important? We have to decide which products we should sell, which ones are more profitable, what are we going to set those prices at, how do we value our cost of goods sold, and then alternately, how do we value our ending inventory? So again, thinking back to what we've learned in past chapters, we have direct materials, direct labor, and manufacturing overhead that are going to get applied to each part. And in this slide, we have two different parts, the alpha and the beta. So again, it's for decision purposes. We don't want to extend the costs over the benefits. We want to understand how costs move through inventory. So we'll have a beginning balance. Transfers in will be added during the period. Transfers out will be subtracted during the period, and then that will leave us an ending balance. We have three types of inventory accounts: raw materials, work in process, and finished goods. If we had no work in process inventory at the end of the year, then that means all of the units that we started were completed and they moved into finished goods. So if we completed and started 100,000 gallons of paint and we have $1 million of costs, again, 100,000 gallons were started, 100,000 gallons are transferred into finished goods. We would take that $1 million, divide it by the 100,000 gallons, and we're going to value that paint at $10 per gallon. So we'd have the 90,000 that were transferred out. It's in year 2, and we have some left in our ending inventory. So 90,000 are transferred out, but we started 110,000 units, and we have 20,000 left, and they are 50% complete. So again, we transferred in 110,000 or started 110,000 gallons. We transferred out 90,000 gallons, so that leaves the 20,000 gallons 50% complete. We always want to focus, though, on equivalent units. So if they're 50% complete, that means we would only have 10,000 equivalent units. So the 90,000 that were transferred out are 100% complete, plus the 10,000 equivalent units left in our ending inventory. So now if we have $990,000 of costs, we're going to divide that by the 100,000 equivalent gallons, and that's going to be $9.90 per gallon, and that is the value that we would charge off then to cost of goods sold. Take that times the 90,000 gallons, and then the remainder will be left in our finished goods inventory, which is the 99,000. If we again have multiple products, so we're not just making one product, we're making two products, we still want to allocate those same product costs out to those different products. So here we have the two products that we are producing, and then we have them totaled in that final column. We know the direct materials assigned to each. We know the direct labor hours assigned to each. What we're coming down to is how do we allocate out the $252,000 in manufacturing overhead. So like I said, we know the direct materials are going, $40,000 to the S72, $36,000 to S66. We know the $150,000 of direct labor cost, $72,000 goes to S72, $78,000 goes to the S66. Those were broken out on that table. So we're trying to figure out how do we allocate the overhead. So we'll take we'll calculate out a predetermined overhead rate. So we will look at our overhead costs, and then we will divide it by a base of some sort. The base should be the activity that is creating that overhead or produces that overhead. And then once we have that amount, so we've got the 252,000 that we need to allocate. If we determine it's direct labor hours, we'll divide it by our total direct labor hours to calculate out a predetermined overhead rate of $40 per direct labor hour. And then we'll multiply those by the direct labor hours charged to each of the different products. So that now we can see direct materials and labor we already figured out. Now that 252,000 we've allocated again based on the direct labor hour. Now, what if it's not necessarily real clear? We could come up with a rate percentage. So then we're going to use our total direct labor costs and get it as a rate. So 168%, and then we could allocate it to each of the products based on that. Again, if we feel like it's not necessarily direct labor hours, but more direct labor dollars, and we want to allocate it that way. Now, sometimes we could be even more precise, or maybe our business is just that precise that we know certain costs are related to the machines, certain costs are related to the employees. So we're going to separate those two and calculate two separate predetermined overhead rates. So we've got our machine-related costs that we'll divide by our total machine hours, our labor-related costs that we'll divide by our direct labor hours. So then we end up with an $18 predetermined overhead rate for the machine hours, $24 for the labor hours. We will then go through and allocate both of those again based on their machine hours and then their direct labor hours. So again, it's a little bit more detail, but as you look at this total, it's still the same 252,000. We're just allocating it out in two different cost drivers. Our product costing systems, we can have ones that we are going to trace to specific jobs or specific contracts, and then those job numbers would be charged as the costs are moved. We can also have process costing where we're making very similar products just over and over again in very uniform fashion, or a continuous flow type process. And in those cases, we're going to use the process costing to do that. And then our operations costing is a hybrid where we have, we're going to kind of combine some of those characteristics between the process costing and the job order costing or the product costing. And those could be for things such as automobiles or computers.